So hey guys, what's up? So welcome to World News 20 new channel. So let's talk about why oil prices well below zero. On Monday, WTI crude price hit minus $40, which means the seller should pay the barrel. Is that as illogical as it seems? A look at what led to the crash and what it means for India and the world. The United States oil markets created history on Monday when prices of West Texas Intermediate WTI, the best quality of the crude oil in the world, fell to minus $40.32 a barrel in an interlay trade in New York. Not only was this the lowest crude oil price ever recorded according to the Bloomberg, the previous lowest was immediately after World War II, but it was also well below the zero mark. At this price, the seller of the crude oil would be paying the buyer $40 for each barrel. That is bad. But how can that be? How did prices fall below zero in the first place? Why would they fall from $0 to minus $5 to minus $10 and then all the way to minus $40 a barrel? Crude oil is not like daily household waste that one wants to pay to get rid of. It is indeed an essential component for modern life and economic growth. So at one level, the negative pricing of oil is misplaced. Yet even though it may look so, this is not an illogical result. In fact, there have been instances of the commodities being sold at negative prices. For instance, natural gas hit negative prices in May 2019 in the US. Moreover, the banking industry has seen negative interest rates where one pays the banks to keep one's money, and bonds have been known to have negative yield, in which a bondholder makes a loss by lending money. How is oil price? The first thing to understand is that even before the COVID-19 outbreak induced lockdowns across the world, crude oil prices have been falling over the past few months. They were close to the $60 a barrel at the start of the 2020, and by March they were closer to $20 a barrel. The reason was straightforward: too much supply and too little demand. To a great extent, oil markets globally and also in the US are facing enormous glut. Historical the Organization of the Petroleum Exporting Countries, led by Saudi Arabia, which is the largest exporter of the crude oil in the world, single-handedly exporting 10% of the global demand, used to work as a cartel and fix prices in a favorable band. It could bring down prices by increasing oil production and raise prices by cutting production. In the recent past, the OPEC has been working with Russia as OPEC Plus to fix the global prices and supply. It must be understood that cutting production or completely shutting down an oil well is a difficult decision because restarting is both immensely costly and cumbersome. Moreover, if one country cuts production, it risks losing market share if others do not follow suit. The global oil pricing is by no stretch an example of well-functioning competitive market. In fact, its seamless operation crucially depend on oil exporters acting in concert. Where did the trouble start? In early March, this happy accord came to an end as Saudi Arabia and Russia disagreed over the production cuts required to keep prices stable. As a result, oil exporting countries led by Saudi Arabia starting and undercutting each other on price while continuing to produce the same quantities of oil. This was an unsustainable strategy under normal circumstances, but what made it even more calamitous was the growing spread of the novel coronavirus disease, which in turn was sharply reducing economic activity and the demand for oil. With each passing day, the developed countries were falling prey to the COVID-19. With each lockdown, there were fewer flights, cars, and industry sectors using oil. What was the impact of the COVID-19 outbreak on oil prices? By the time the discord between the Saudi Arabia and Russia was sorted out last week under pressure from the US President Donald Trump, it was possibly too late. Oil exporting countries decided to cut production by 10 million barrels a day, the highest production cuts, and yet the demand for the oil was shrinking faster. This means that the supply-demand mismatch continued to worsen right through the March and April. According to reports, the mismatch resulted in almost all storage capacity being exhausted. Trains and ships, which were typically used to transport oil were used up just for storing oil. It is also crucial here to understand that the US became the largest producer of the crude oil in 2018, and that is the one reason why, unlike all previous US presidents who always pushed for lower crude oil prices, especially in an election year. Trump has been pushing for higher oil prices. What happened on Monday? The May contracts for the WTI, the American crude oil warrant, were due to expire on Tuesday, April 21. As the deadline approached, price started plummeting. This was for two broad reasons. By Monday, there were many oil producers who wanted to get rid of their oil even at unbelievably low prices rather than choose the other option, shutting production, which would have been costlier to restart when compared to the marginal loss on May sales. From the consumer side, that is those holding these contracts, it was equally big headache. Contract holders wanted to get a wrinkle out of them, the compulsion to buy more oil as they realized quite late in hindsight, and that was there was no space to store the oil if they were to take delivery. They figured out that it would be more costly for them to accept the oil delivery, pay for its transportation, and then pay for storing it, possibly for a longish period, and giving the circumstances, especially when there was no storage available, than to simply take a hit on the contract price. The desperation from both sides, buyers and sellers, to get rid of oil meant the WTI oil contract prices not only plummeted to zero, but also went deep into the negative territory in a short term for both the holders of the delivery contract and the oil producer. It was less costly to pay $40 a barrel and get rid of the oil instead of storing it. Buyers are stopping production producers. What is the future of the oil prices? It is important to note that it was the WTI price for the May in the US markets that went so low. Crude oil prices elsewhere fell too, but by not so much more, at least for now. Oil prices for June and the coming months are pitched between $20 and $35 a barrel. It is possible that this was one of the events where prices dropped below zero because of an existing glut in the WTI oil, which is found inland, and there was no space to store or transport it in hurry. Investment budgets of exploration and production companies are expected to drop in the face financial turmoil due to the low shale oil pricing. Normally, this should force oil exporting countries to cut back production and negate the excess supply, restoring some balance in the oil markets. But one cannot rule out a repeat of the Monday's trend, because with COVID-19 continuing to spread, global oil demand is falling every day. In the coming quarter, some estimates claim that the total demand will fall by 30%. In the end, it would be the demand-supply mismatch adjusted for how much can be stored away, and it will decide the fate of the oil prices. How will this impact India? The Indian crude oil basket does not comprise WTI. It only has Brent and oil from some of the Gulf countries, so there is no direct impact. But oil is traded globally, and weakness in the WTI is mirrored in the falling prices of the Indian basket as well. There are two ways in which this lower price can help India. If the government passes on the lower prices to consumer, then whenever the economy recovery starts in India, individual consumption will be boosted. If, on the other hand, governments both at the center and the state decide to levy higher tax on oil, it can boost government revenues. So if you like the channel, so kindly subscribe to it.